So you have $500 and you want to invest it. Good. That decision alone puts you ahead of the majority of people who keep saying they will start and never do. But now comes the part where most beginners get stuck. Not because investing is actually complicated, but because nobody has ever walked them through the first steps clearly enough to feel confident taking them. That is what this video is for. By the end of it, you will know exactly how to get started with $500. No confusion, no overwhelm, just a clear path forward. If you are new to this channel, welcome. This is part of an ongoing series about building real wealth starting from just $500. Subscribe and turn on notifications so you catch every video as it drops. And if you find this helpful, hit the like button. It genuinely helps this content reach more people who need it. Let's get into it. First, get your mind right. Before we talk about apps, accounts, or anything practical, we need to address the biggest obstacle most beginners face. And it is not a lack of money or knowledge, it is mindset. Most people approach investing with one of two wrong attitudes. The first wrong attitude is thinking of investing like gambling. They want to pick the hot stock, double their money fast, and get out. This approach loses money almost every time. The people who treat the market like a casino eventually get burned, and most of them never invest again. The second wrong attitude is being so afraid of losing money that they never actually invest at all. They research endlessly, open accounts they never fund, and watch from the sidelines while their money loses value sitting in a savings account earning almost nothing. The right mindset is somewhere in the middle. Investing is not gambling, and it is not a savings account. It is a long-term tool for building wealth. The stock market goes up and it goes down. Sometimes it drops a lot and stays down for a while. But historically, over long enough periods of time, it has always recovered and gone higher. If you can accept that reality, that your money will fluctuate, that some days your portfolio will be down, and that none of that matters as long as you stay the course, then you are ready to invest. If you cannot accept that yet, spend some more time with this video and the others in this series before putting any money in. Investing with the wrong mindset is more dangerous than not investing at all. Step 1. Define your goal. The very first practical step before you open any account or buy anything is to define what you are actually trying to do with this money. Are you investing for retirement, for a house in 10 years, to build a general wealth base with no specific target? To learn how investing works before putting in larger amounts later? Your goal matters because it determines your strategy. Someone investing for retirement in 30 years can afford to take more risk and ride out market volatility. Someone who might need the money in 3 years needs a much more conservative approach. For most beginners starting with $500, the goal is usually one of two things: either building long-term wealth with no specific deadline, or learning the fundamentals of investing with a real but manageable amount of money. Both are completely valid. Just be honest with yourself about which one applies to you, because it will shape every decision you make from here. Step 2. Choose where to invest. Once you know your goal, you need somewhere to actually invest your money. This means opening a brokerage account. A brokerage is simply a platform that lets you buy and sell investments. There are many options out there, and the good news is that most of them are free to open and charge zero commission on trades these days. When choosing a platform as a beginner, look for 3 things. Number 1, no minimum deposit requirement. Some platforms require you to deposit a certain amount before you can start. Look for ones that let you start with whatever you have, even if it is just $500 or less. Number 2, fractional shares. This is huge for beginners. Fractional shares allow you to buy a small piece of a company even if the full share price is higher than your budget. Without fractional shares, buying into certain major companies would cost hundreds or even thousands of dollars per share. With fractional shares, you can invest as little as $1. Number 3, a clean, easy-to-understand interface. You do not need advanced trading tools right now. You need something that is simple enough that you can find what you need without getting overwhelmed. Do your own research on which platform is right for you based on your country, your goals, and what feels comfortable. The platform matters less than actually starting. Step 3. Understand your account type. This is something a lot of beginners skip completely and then regret later. Before you fund any account, understand what type of account you are opening. The two most common types for individual investors are a standard taxable brokerage account and a tax-advantaged retirement account. A standard brokerage account lets you invest in almost anything and withdraw your money whenever you want. The downside is that you pay taxes on your gains. A tax-advantaged account, like a Roth IRA in the United States or an ISA in the United Kingdom, lets your money grow tax-free or tax-deferred depending on the account type. The trade-off is that there are rules around when and how you can withdraw the money. For someone starting with $500, a tax-advantaged account is often the smarter long-term choice if you do not need access to the money anytime soon. But again, this depends on your specific situation, your country, and your goals. This is one of those areas where speaking with a financial advisor, even just once, can save you a lot of money in the long run. Nothing in this video is financial advice. It is education to help you ask the right questions and make informed decisions. Step 4. Decide what to buy. Here is where most beginners spend way too much time, trying to figure out the perfect thing to buy before they buy anything. There is no perfect. But there are smart starting points. For a beginner with $500, the single most recommended starting point among financial educators is a broad market index fund or ETF. We have a full video coming on ETFs specifically, so I will not go deep on them here. But the short version is this. An ETF is a collection of many different stocks bundled together into one investment. When you buy an ETF that tracks the overall stock market, you are essentially buying a tiny piece of hundreds or thousands of companies all at once. Your success is tied to the overall performance of the market, not to any single company. This is powerful for beginners for two reasons. First, it removes the pressure of picking individual stocks. Second, it provides instant diversification, which means your risk is spread across many companies rather than concentrated in one. A beginner with $500 could put all of it into a single broad market ETF and have a genuinely solid, historically proven investment strategy. It is not flashy. It will not make you rich overnight. But it works, and it works reliably over long periods of time. From there, as you learn more and get comfortable, you can start exploring individual stocks, sector-specific ETFs, bonds, and other options. But if you are starting today and you are not sure what to buy, a broad market ETF is a completely reasonable first move. Step 5. Start small and build the habit. Here is the part most people underestimate completely. The $500 you invest today matters, but the habit you build around investing consistently over time matters even more. Think about it this way. If you invest $500 once and never add to it, you are relying entirely on that $500 to grow on its own. And while it will grow over time, the impact is limited. But if you invest $500 today and then commit to adding even $25 or $50 every single month, the picture changes dramatically. You are now building momentum. Every contribution adds to the base that compound growth works from. The returns on your returns start to stack up in a way that feels slow at first and then suddenly feels very significant. The habit is the most valuable thing. The amount almost does not matter in the early stages. What matters is that you get into the practice of treating investing like a bill you pay yourself every month. Non-negotiable. Automatic if possible. Most brokerage platforms allow you to set up automatic recurring investments. If yours does, use it. Remove the decision from the equation. Let the habit run on autopilot. What to avoid? Before we wrap up, I want to quickly cover 3 things beginners should avoid because these mistakes cost new investors real money every single year. Mistake number 1. Checking your portfolio every day. This sounds harmless, but it is genuinely dangerous. When you watch your portfolio fluctuate daily, you start making emotional decisions. You see a dip and panic sell. You see something going up and chase it. Daily checking creates anxiety, and anxiety creates bad decisions. Check your portfolio once a week at most when you're just starting out. Mistake number 2. trying to time the market. This means waiting for the perfect moment to buy because you think the price is about to go lower, or waiting to sell because you think it is about to go higher. Professional fund managers with teams of analysts and decades of experience cannot reliably time the market. Beginners definitely cannot. Time in the market beats timing the market every time over the long run. Mistake number 3, following hype. When everyone online is talking about a certain stock or cryptocurrency and saying it is about to explode, that is usually the worst time to buy it. By the time hype is everywhere, the price has already gone up significantly and the risk is at its highest. Invest based on fundamentals and long-term thinking, not because something is trending on social media. Avoid these 3 things and you are already ahead of a huge portion of beginner investors. Quick recap. Let me quickly recap what we covered today. Step 1. Get your mindset right. Investing is a long-term tool, not a get-rich-quick scheme. Step 2. Define your goal before you invest a single dollar. Step 3. Choose a beginner-friendly brokerage platform that offers no minimums and fractional shares. Step 4. Understand your account type and the tax implications before you fund it. Step 5. For most beginners, a broad market ETF is the smartest first investment. Step 6. Build the habit of consistent contributions, even small ones, and let compound growth do the work over time. And avoid the 3 big mistakes: daily checking, trying to time the market, and following hype. That is how you start investing with $500. It is not complicated. It does not require a finance degree or inside knowledge or perfect timing. It requires a decision, a platform, and the discipline to leave your money alone and let it work. If this video helped you, please hit the like button. It takes 1 second and it helps this channel reach more people who are looking for exactly this kind of guidance. Subscribe if you have not already, because the next video in this series breaks down ETFs in complete detail: what they are, how they work, and why they are one of the most powerful tools available to everyday investors. Leave a comment below with one question you still have about getting started. I read every comment, and your questions help shape future videos on this channel. Wealth starts with a decision. Make yours today. See you in the next video.